We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Dorr from CORO Global. He's the co-founder of that company. How are you today, David?
I'm doing well, Tom. Thank you.
Excellent to have you. So I was thinking we could just start by give us a little bit of your background, and we can kind of get into the CORO story from there, please.
Sure. So yeah, I've got a little bit of an unusual background as it relates to capital markets. I come across kind of three intersections that all meet together. And one of those is fintech. The other one is global macroeconomics. And the third piece of that is complex regulatory environments. So my brother and I moved to Miami in 2001 to set up a global macro hedge fund and ended up getting recruited into the life insurance market. And this was a very interesting period. This was in about 2002, 2003, where life insurance markets were starting to converge with capital markets on Wall Street as risk was starting to transfer and new mechanisms for securitizing life insurance and developing derivatives. So obviously a very complex regulatory space as well. And so been in that sector my whole career, been around trading since I was 16, and basically just a financial nerd at the end of the day. So it's quite high level.
That plays really well into kind of the product that you're developing at CORO, correct?
Definitely. Yeah, that's why I mention it, because a lot of people are like, how do you tie your background together with CORO? And it's on all three of those points, right? Absolutely. So when you look at money transmission, the business CORO's in, that's very much a highly regulated space. You look at fintech, that's a very hot space. I've been in fintech since before it was a buzzword. And then you look at the macroeconomic side, which is where the gold comes from, and obviously why we're very pro gold.
So tell us a little bit about how the pandemic and the financial crash that we've seen since then has really made a tool like CORO very important, and tell us a little bit more about how CORO actually works.
Sure. So I think one of the biggest things that was accelerated from the pandemic is the convenience of being able to make electronic payments. Whether you're making a payment on an e-commerce site and you got to order some masks and gloves from Amazon, whether you need to make a payment on Venmo to your friends and family, whatever it may be, everybody started saying, listen, I don't want to touch physical cash. One, it might be dangerous for my health. Two, it's not as convenient. And the pandemic accelerated that absolutely, literally all over the world. And for us, that was beneficial for us as a company, having just released our product in August. We are a money transmission business. And what we do is we allow people to transact, not just in dollars, fiat, but most importantly, we were built from the ground up to be able to use gold as money and be able to use it in a modern way. So the pandemic's definitely, despite it being a very tough situation for all of us around the world, it has been beneficial for accelerating our company's value proposition.
So something you said there, David, you're looking at modernizing gold. So tell us a bit more about that, please.
So the problem when we look at the history of gold and its role that it's played is gold's amazing. So obviously, I'm kind of preaching to the choir with a lot of your audience here. You guys know and understand and appreciate the value of gold. And one of the reasons paper money was created, paper money more than anything else was really created as a technology at the time. And it just made it easier as representations of what was supposed to be gold, physically held on custody for you, to use that as money in commerce. So it was a convenience factor through technology. Well, today's terms, if we want to bring gold back as money, using it in physical format, chipping off a piece of the block and paying for coffee is not practical. And people don't want to be able to use things that paper money or some sort of certificate. They need a digital representation of that. And so what we looked at, this is not a novel idea. Lots of people have gone about this over the years, many people, is we looked at it and we said, well, what are the holes in the way? Why is this not happening? And we took a very, very deep 10-year-long technology deep dive on what was going on with the underlying rails and plumbing. And that's part of my regulatory and fintech background on that. And we identified some of the gaps there, and we figured out how we could remedy those so that people would be able to confidently and in a modern fashion be able to use gold as money. So that's why we exist.
Excellent. So tell us a bit more. There's three main problems that basically CORO solves. So tell us a bit more about what those three main problems are.
Sure. So what we zeroed in on, there's these problems that we solve are, the first is that currency is being devalued. It's all over the place. Now, again, your listeners here are very familiar with that. We all know what happened, post 1971, purchasing power in dollar terms is just completely fallen apart. But more recently, when we look at currency markets in Lebanon, as an example, we look at Turkey this year. Last year, there were 6 countries with inflation rates greater than 50%. We're kind of reaching that end stage, and it's accelerating as it always does. This is not hysteria. This isn't the sky is falling. This is just mathematics. And so we're in this kind of liftoff phase for currency devaluation. And the question is, well, it's not whether or not we're able to prevent the next crisis. It's what do you do afterwards? How does society start to grow again? And just investing in gold is not enough. We need to be able to utilize it and return to its roots. So that's the first problem. The second one is that there's a huge issue with financial inclusion. Now, United Nations talks about this, and they define people without access or limited access to financial services as unbanked or underbanked. And in the early days when blockchain was coming out, Bitcoin, most famous, everybody said, "Oh, this is going to cure it and open up financial services for the masses." That's not true. And the reason that we identified that was such a bottleneck, it's a compliance issue. The compliance cost for getting people into systems, it's just too high. You go to Mexico as an example, it could cost a bank $400 to $700 per customer that first year of doing basic compliance on them. Well, that shuts a lot of low-income individuals and families completely out of the system. There's no way the banks can be profitable with that. So we completely re-engineered the way that compliance was being done. That's a very messy sector. A lot of people just treat it as an afterthought in fintech, or they ignore it completely, which is even more dangerous. And we're seeing SEC headlines related to companies that didn't take this too serious. So we dealt with the compliance piece to resolve unbanked and underbanked. And one thing that I always point out to people is there's this general thought that for folks that don't have access to financial services, that's an emerging market type issue. That's something that you're seeing in Latin America and Africa and parts of Asia. That's everywhere. In fact, in the United States, 1 out of 5 Americans are classified as unbanked or underbanked. So this is a very, very, very real issue. In fact, nearly 1 out of 5 Americans is on food stamps. And of course, with more stimulus being necessary with the pandemic, these things are getting worse. So that was the second issue. And the third is just really like how do we resolve people being able to transact with trust again? There's all this talk about creating trustless networks, but I would submit to you and the entire audience, that's completely backwards. We have a complete trust issue. Creating all these crypto networks and stuff, I understand those things were born out of environments where we lost faith in financial institutions. What we need is a new set of financial institutions built from the ground up to reinstill that. And so we're very focused in the mechanisms that make that possible, and they build that for the long term.
So when you're talking about compliance, how did you guys deal with that issue, and how did you make it that much easier for people to be able to really get onto that network?
Yeah, it's a good question. So what's interesting is when it comes to compliance, it's not sexy. Nobody wants to deal with it, right? It's a pain in the butt. And what we did was we literally dissected all the components of compliance, like what's necessary, how do we make that easier, but also more effective? Because having been in financial services for a long time, and I'm deeply libertarian at heart, so I'm not a huge fan of having tons of regulations. There are frameworks, though, that make a big difference. And for people that want to just completely burn down that system, you really need to see the dark side of financial transactions where people are laundering money and they're doing really, really scary stuff. So a lot of those frameworks are intelligently designed. The problem is the technological process for managing those. So let me just give something that's really, really easy for listeners to understand. And then you can just imagine that times 30 steps. If you're an international citizen and you want to open a bank account with any international bank. A standard part of that process is you need to take a color copy of your passport and have that notarized. And then you need to sign that with we call in the compliance industry with wet ink, and then FedEx that to the bank, right? And that's in addition to showing up in person for them to validate you. That's crazy. That's a ridiculous process. We have access to over 180 government databases where we can scan a passport and scan our user, scan it using the technology that's sitting right there in their phone with great, fantastic biometrics, 17 points of biometrics, cross-check that database versus what we're picking up on the phone and ensure that that's the same person. So we can do that within seconds versus wasting a week, chasing down a notary and making color copies of your passport and things like that. And every step along the way, we just thin sliced it and just looked at everything that wasn't working right and just smoothed out that process.
Yeah, and it really makes you think about how technology should be making things more efficient and easier to do. And you guys are really taking advantage of that in that case, right?
That's exactly right.
So the other part of what you were just saying there about the trustless or trusted, let's say, transactions, to have gold back your, let's say, transactions, is that part of how you get around a lot of that compliance, is basically having an asset that's backing your transactions?
Well, no, it's separate from that. So what's interesting is the regulatory framework, whether you're holding on custody, dollars, euros, or in our case, part of our custody, a significant component of that is holding physical gold. That framework's pretty much the same. What becomes valuable, and this is where a lot of people just kind of overshot with looking at distributed ledger technology. They got really hyped up about the tokens and everything else, things that we'll probably touch on here in a bit. But the big benefit of the ledger is creating additional audit trails and rails. So we use this term rails or piping of the underlying system and being able to create better granularity. So we deal with allocated gold. This is really important. We spent nearly 16 months going back and forth with the SEC to document and show, look, here's how we make sure that our customers have title. This is not unallocated gold. This is not pooled gold. This is allocated gold with title to our customers, whether it's $1 worth or it's $1 million worth. And there is no token on our platform. So you don't get some weird unit of account that's backed by gold. When you see it, and this was something else that we did too, that we felt really passionately about. When you see your account balance, it's priced in XAU. Now, XAU, when we look at the International Standards Organization and their responsibility for creating currency codes, so dollars, USD, Canadian dollars, CADs, everybody's familiar with their currency codes. XAU, as you're well aware, is the currency code for gold. And it's important to use that. That represents 1 troy ounce. So we use that. So you're not seeing $100 backed by gold. When you see 1 XAU, you have 1 troy ounce in your name, in your title for you. If it's a half an ounce, a 1/10 of an ounce, and so on, it's very specific to that. And that keeps it a lot cleaner. We want to re-educate people that, listen, we want people to think in terms of XAU, not some sort of strange unit of account, something that's already existing and well integrated into financial systems.
So is it obviously necessary to have some amount of gold backing your account? Well,
so the way that it works is we have to keep, of course, a balance sheet for customers as we're doing transactions. So when a customer buys gold for us, we settle in real time. So let's use a real example with how the system actually works. You download the app. It allows you to connect into the old banking system. So in the US, we're piped into the entire US banking system. We have our federal license. We're licensed in 21 states right now. And it allows you to then fund that account. Now that can take up to 72 hours because you're riding on those old rails. Once you're in there, so let's say you put over $100 US dollars and you say, you know what, I want to buy $50 worth of gold. So you're able to buy that instantaneously. We settle that in real time. That's in our cage. That's then allocated. It's titled and in your name instantaneously. So your account will now show $50 worth in XAU, which is going to be 0.00, whatever that calculates out to. And you'll have $50 in USD. So you have the $50 cash held in the cash custody side of your account, and you have that equivalent amount in gold, now held in gold in the gold custody side of the account. So the gold's always there. That's, of course, everybody that comes from having had an affinity for gold All of us, our biggest paranoia in the world is my gold there? Is there physical gold? Can I touch it, feel it, get it? Is somebody auditing it? How's this, handled? So we're as obsessed with that as every customer we expect to have would be.
Excellent. So give us some idea of how like what the actual use is. Could you just go down to the grocery store and use this, or do you need certain let's say retailers to accept that?
Eventually, yes. So what we're doing is what we rolled out in the United States. So the first leg of our product is to be able to do transactions with individuals. That's the low-hanging fruit and the easy entry point. The next phase will then also allow the ability for corporate accounts. So we'll look to launch that in 2021 so that you can do exactly that. You would be able to go to your local cafe and pay them in gold or dollars if they prefer, and say, hey, listen, just pay me in dollars instead, and you need to move some of your gold balance back to dollars. It's no problem. It's instantaneous. So corporate accounts will come in 2021. We've got a bunch of things in the pipeline, including attaching debit cards. So debit cards then give people the ability to just go spend those balances literally anywhere that somebody takes the Visa, MasterCard.
So at this point, we're only able to transact between other account holders.
That's correct. Yep.
Okay. Tell us a little bit more about why gold and distributed ledger technology are a match made in heaven, David.
Yeah, they're fantastic. It's like peanut butter and jelly, right? The problem is a lot of people they mix match these things. Bitcoin, is it digital gold, and then different iterations of blockchain. People just didn't really do their homework. That's what's been missing for the last 10 years. But they're really, really, really naturally complementary, right? So we know for a fact that everything's going digital, right? Nobody wants to return to cash. Nobody wants to carry a backpack and have gold. This is not to suggest that you shouldn't keep cash on hand and keep physical gold in your home. This is not what we're promoting. We think everybody should always maintain some physical gold on them in person. That's very, 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 very important. But in everyday life, you want to be able to transact in the way that's most convenient. And so what distributed ledger technology is specifically changing, it's changing those underlying rails. Let me give the audience an example here. When we look at the speed of transacting, I always talk about the speed of settlement. So when we look at trading equities, stock markets, it's been a huge boom in stock markets. Robinhood traders are making a ton of money this year. Everybody, it's like the late 90s. There's a lot of day traders and they're going bonkers. But what would probably surprise all those day traders, what most of them do not know, is that in what we call in the back end plumbing of markets, the settlement time is a T+2 market. What does that mean? The T represents the date of trade, +2 is the number of days to settle and reconcile that transaction. So you have all this high frequency trading on the front end, but the back end piping is so slow and bloated, it's 48 hours to actually net that out. Now, most people don't notice the difference because they're brokers and all the back end plumbing's handling that for them, but that's how broken it is. Now, when you look at the 6 trillion plus traded currency market, same problem. It's on average a T+2 market. This is just crazy. So the benefit of DLT, and you're noticing I'm using the term distributed ledger technology because that's really the umbrella term. Blockchain's just one branch. The type of tech that we use, which is much more advanced, is a much more modern branch of that, but they fall under the DLT umbrella. So DLT's promise is that, hey, you can speed those rails up with better cybersecurity, better integrity, better auditing, better transparency, better resiliency. So it's just better rails underneath. And that's what we found enticing. Now, you combine those rails with something that we all love and have familiarity with, gold, you're taking that kind of kinetically stored energy in gold and you're just catalyzing it. So now it doesn't have to just sit there. You can actually bring it back into society and start using it, which is what we feel is so super important.
Mm-hmm. And to really give us an idea of the type of speed that let's say the network that you guys are using, tell us more about the Hashgraph system and why that is such an advantageous way of going about using this technology.
Sure. So I'm going to unpack this in two parts. The first piece with Hashgraph and what it's most known for is speed. It's just ridiculously blazing fast, capable of transaction speeds upwards of 500,000 transactions per second. And when I share this with people, I always like to put it in context so that they've got some sort of benchmark for what that actually means. 500,000 transactions per second for Hashgraph versus the speeds that are estimated for Visa and MasterCard, which are approximately 25 to 30,000 transactions per second. So you're nearly 2,000% faster in that throughput. And when we go further down the line, if we look at just blockchain stuff like Bitcoin's at like 3 to 7 transactions per second. This is one of the reasons that Bitcoin's just complete nonsense. There's so many people that like, they pump Bitcoin, but they don't really mechanically understand anything about how the way that it works. 99% of those transactions for Bitcoin have to happen off chain because the network's too darn slow. Hashgraph doesn't have those problems. Now, the second piece of Hashgraph that was vitally important for us. So when we spent a decade looking at every iteration of DLT technology as it was coming out, we knew early on that the early versions were good drafts. They were good starting points. So not taking anything away from the Bitcoin community, the developers, all the folks that have helped kind of reiterate and build better and better and better systems, brilliant work. But we have to be honest about the limitations of those early systems, like all tech. So the tech finally evolved and got past some of the roadblocks, which was speed, security. Security is still very much a very real issue in blockchain, and the need to use a token to operate the exchange. This is vitally important, and Hyperledger was the first to get away from that. And I explain this to audiences as always understanding that, look, let's take the most familiar blockchain, it's Bitcoin, right? Bitcoin is two technologies. It's Bitcoin with a little b, which represents the token, and Bitcoin with a big B, which represents the ledger, the blockchain itself. They're glued together. You can't use one without the other. Okay. So if that's the case, that doesn't make something good money. Like your ATM is a network, right? Your ATM is a network. You don't want your ATM affecting the amount of money that you withdraw or the amount of money that you're depositing. That would be completely dysfunctional. Well, everybody in blockchain just completely overlooked that. And then it got more absurd because this was a technological limitation. People started justifying weird things like utility tokens. What does that mean? There's not one person on the planet that can tell me what a utility token actually means. It's just a completely ridiculous term that is meaningless. So what happened was Hyperledger from IBM and Linux Foundation, they came out and they got away from that. And this was smart because we had the same thesis. That's exactly what we spotted a decade ago. We said, somebody's going to solve this. Some wizard will solve this and figure out how to get past that. And then you're left with a pure ledger. If you want to create some sort of digital money, similar to Bitcoin or something else, you can create it. You can create a token. If you want to track gold, dollars, a FedEx package, you have a tracking and audit system there that's just absolutely unparalleled. And this was the key breakthrough for us. So that first happened with Hyperledger, and then Dr. Lehman Baird advanced that literally 100x with his invention of Hashgraph, which works on what's called directed acyclic graph. That's a whole rabbit hole to go down, but people can look this up on. They just Google directed acyclic graph and Hashgraph, and they can read, how different that tech is and how it really speeds things up.
So, David, as we're talking about, let's say, the similarities of Bitcoin and gold, tell us a bit more about like the advantage of one over the other.
So, look, the first thing is that everybody acknowledges that Bitcoin was trying to replicate gold. If you go do an image search for Bitcoin, what do all the images of Bitcoin look like? All the images coins are gold coins, and they just put the Bitcoin symbol on it, right? So this is what's a bit comical to us, because there's this raging narrative right now, Bitcoin versus gold, and people are so passionate about it. This to me is just completely silly. It was always trying to be gold. And if all you're talking about is how to use gold in a digital format, okay, well then that's looking at tech specs, right? Like if you and I were going to talk about how to stream high definition, television into our house, we'd be looking at the tech specs to do it. There wouldn't really be any of this debate about it. But people got all religious about Bitcoin, and now they crap on gold and they say Bitcoin's better. So there's some key differences. So first is acknowledging the history. Bitcoin was trying to be like gold, simply in a digital format. Okay, and it did do some clever things. This idea of trying to create a way to interact in a distributed database with others in a trustless environment. Very, 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 very cool stuff. But there's some errors in the thinking. So people with Bitcoin, one of the things that they forget is that physical gold has a real barrier to entry. And as I love to joke, unless we get hit by a meteorite that introduces a new element to the periodic table, there's only a handful of precious metals: gold, silver, platinum, palladium, a couple other, rare ones. Okay. It's that simple. But while there's a limited supply of Bitcoin, while there's a limited supply there's no barrier to entry to create other digital currencies. And that was our very first thesis. I've never owned Bitcoin. I wished I did. I regret that. I totally should have speculated on it. And then, I'd be on my yacht in the Caribbean right now and relaxing and not on your show. But I didn't. And that's okay. But the reason I didn't is because that didn't make sense to me. And there's been thousands. I think the total count's like 40,000 cryptocurrencies that have been created since then. So that's a substantial difference. Now, the other thing too is that people think that, okay, again, well, it's limited. There's only Bitcoin. There's only going to be so many of these. There were only so many Beanie Babies in the 90s. Beanie Babies was a huge craze for stuffed animals, and the market fell out from underneath that. People forget that markets, it's not just about a constraint of supply, it's what's the demand. Mm-hmm. And so that's a really big dynamic that I just see people completely skip over. Mm-hmm. The other issue too is that, as many people have postulated and lawsuits have shown against some of the big LBMA banks, is that gold prices tend to get manipulated downwards. Bitcoin prices tend to get manipulated upwards. And the data on Bitcoin prices is way better than what we've seen even on gold over all these years. Because you have the chain, you can now track it. So you can see this data. And there is absolutely a direct correlation between pump and dump activity on exchanges and what you see with Bitcoin. And the most egregious of these is the Tether fraud. So Tether has printed, just since you and I scheduled this show, an additional $1 billion in tethers. And for your audience that doesn't know, a tether is supposed to be a US dollar. It's up 400% in supply. There's $21 billion worth of tether. There's never been a financial audit for this company. There's no proof that money exists. And miraculously, Bitcoin is up. There's some computer scientists that have shown there's an absolute direct correlation between the printing of Tether and the increase in Bitcoin. And those are big differences between Bitcoin and gold.
One of the other points I'd like to hit about, let's say, Bitcoin versus the Hashgraph system is that you were saying that it's 100% verifiable on the Hashgraph system, right?
Yes.
Like, what is the difference there?
That's an important piece to distinguish, and I'm glad you picked up on that, because a lot of people don't catch that subtle yet important nuance. And what you're asking about is the mechanism of reaching consensus. Okay, so let's take a step back. Again, I'm really big on just making these things in simple terms. I don't have my PhD in computer science. I presume not too many of your audience members do, and for those that do, pardon the layman's examples here. So first, why should we even care about distributed ledgers? Think about it like the cloud on steroids. Every one of us has benefited by having cloud services, right? You drop your phone in the gutter or the toilet and it ruins the phone, but you haven't lost, photos of your wedding and your kids and your pets and other important information, right? So that's thanks to your information being backed up in the cloud. But your information is really backed up in cloud data centers, right? Amazon, Google, Microsoft, the big data centers. And they got data centers all over the globe. They try and, spread that out. Well, what distributed ledgers do is it allows you to do that, but on steroids. So you can just scatter that into, a million places, and you can appreciate that the resiliency is much greater when you do that. If you have secure record sets, secure being a very important component of this, then you have better resiliency. Okay, so starting with that. Now, the question then becomes, if you have these record sets synced up, how do they sync? Because for them to sync and be accurate is vitally important. And another familiar example is your Dropbox. So if you lost 1% of your Dropbox files or Microsoft OneDrive, you wouldn't be happy about that. That would be completely a pain in the ass for your business, your personal life, might even be a disaster. You lose an important legal agreement or anything else. Well, so the syncing mechanism, what they call in distributed ledgers, what they talk about is reaching consensus. So now we're talking about what is the mechanism that allows these things to reach consensus? How does it function? Well, in blockchain, the two primary methods for reaching consensus are proof of work and proof of stake. Now, what Dr. Lehman Baird did that was just brilliant, and it took us months and months and months and months as a team just to get our brains wrapped around it, is that he looked at a different way of coming to consensus, which uses virtual voting and what he calls a gossip about gossip protocol. And again, this gets very technical. People can look it up, but here's the key part. Proof of work methods, the difference there is that's a probabilistic method, meaning it might get synced up 99% accurate, but not necessarily 100%. Whereas the method that Lehman Baird with the Hashgraph algorithm, it's mathematically provable and certain that it gets 100% in sync. And that for us was a game changer because we work with, vital networks. Look, if we were selling crypto kitties, who cares? Doesn't really matter. But when you're in financial services and you're talking about people's money and transactions, it's absolutely mission critical that that's 100% and verifiable that it's 100%.
Mm-hmm. So if we're only able to, let's say, back this new or use gold to transact against, let's say, is there any risk that we would, if we got everybody on board this system, to really, in a way, return to the gold standard?
I think, what we're about is we want people to return to the gold standard, but in a much more effective way, right? When we look at the gold standard or different gold pegs and different iterations of that, they all involve some type of something in front of them, right? Some sort of fiat money there in front or a fractionalized version of it, or even if that was supposed to be just a complete gold certificate, gold good, right? Mm-hmm. That's still called a dollar or a pound or something else. We think that's completely broken. And this is why we're so big on, instead of trying to be cute, create a token, because that's what's cute and going on in the digital space, or be old school, which is create some type of new paper money. We want to skip past all that and keep it pure. It's an XAU. XAU equals 1 troy ounce. A troy ounce is a troy ounce is a troy ounce. Mm-hmm. And we believe that that's the way to reintroduce a gold standard. Now, there's other important components of this, as you're well aware. A lot of times the gold standard has been criticized by different economists, that caused the Great Depression, and it's been blamed for all types of other ailments. The other issue that is horrible for the financial system, it's not just that there's no gold being used, there's nothing backing it, that it's just kind of vapor. It's that, of course, that we're on a fractional reserve standard as well. And so that change in legislative approach where 100% reserves are required is vital. And that's something where we're leading the way by being in a regulated environment where we hold 100% reserves on custody balance. We're aiming to change that in a very, very complex, messy regulatory environment and set new standards there, whether they are mandated by law where we move back to 100% standards. We do that from jump. But those pieces are necessary to get us back to gold really working in society.
Excellent. So what about the need for a currency to expand or inflate to be able to support more users and more people actually using it? Does that thinking make sense?
There's interesting studies on that, right? That's been a big debate, and even within the hard money camp, there's gradients of whether or not it needs to inflate. I think the jury's out on that. Some people say, hey, look, the inflation rate of gold through the mining process is just about right, dealing with some population growth and everything else. I think that the most important thing is that you do have real constraints, that there is a real defensible throttle, whether that's set to 0 or it's within a couple percent. We could get into finer debates on that, but I don't think it's as relevant. What we do know is that, like the Federal Reserve's done this year by adding, another 24% to the money supply, that doesn't work. That's a guaranteed recipe to absolutely, completely, utterly blow up. And I think that all else being equal, people would certainly prefer a savings account that appreciated over time in purchasing power, and instead of getting inflated away.
Absolutely. So I know you were saying in other interviews, David, that you thought the dollar would have blown up by now. So what things do you think need to happen for it to fail?
Oof. A lot of things, right? One of our key themes being in the, in global macroeconomics that we looked at back in the financial crisis that was really interesting is that US treasuries were starting to take on the money-like qualities of cash. So what do I mean by that? Well, we were just talking about fractional reserve banking. So, credit is created out of thin air by banks, not the Federal Reserve. A lot of people think that it's just created out of thin air there. It's really at the commercial banking level. But that gets multiplied. What people hadn't been looking at prior to the crisis, quantitative easing and everything else, is what's this kind of velocity factor and this multiplication of treasuries being used as collateral and then rehypothecated around the system. And it's still a little bit murky to know what's going on there. But it's a huge part of the grease of the entire global financial system. So it's a big component. The most likely scenario in the view that we've had for the last decade is that more likely than not, we're going to see a big heart attack in the dollar where the dollar rises and rips everybody's face off and then collapses. That's much more logical. And we can point to a lot of things with that. Not only is it the grease and the lubricant in the global system, so it's more important than any other fiat by far. But it's also when you look at the amount of US dollar denominated debt by foreign countries and foreign multinationals, they have huge debt loads there. So I think you need to see an implosion in that first. And look, if you'd asked me in my career if we would ever see negative yielding sovereign debt, I would say no way. And now we're 17 trillion plus of negative sovereign yielding debt. You have option adjusted spreads on junk bonds, the kind of the worst credit quality stuff. You have option adjusted spreads are a little over 4%. That's crazy. When those things start to break, and eventually they will, whether it's 2021, 2022, we're running to the end there where like there's just not a lot left that can be done. You can only go so negative, and then it just goes splat. So we're in that exponential phase. And I think when those things trigger, you see a huge upswing in the dollar first, and then it croaks. Now you could see gold and the dollar go up simultaneously in that environment. That's entirely possible, or you could see a big sell-off in gold as people are selling their good assets to meet U.S. dollar denominated obligations. Either scenario is a very real possibility.
Mm-hmm. That kind of brings me back to a thought about when you're saying that the dollar could rise sharply and then just totally crater. What would that do to let's say the value of the gold in your account, in your CORO account?
Well, so when we talk about this, remember, because it's measured in XAUs, so let's say you got 1 troy ounce and you look at your CORO account, and no matter what happens, whether the dollar skyrockets or the dollar collapses, it's still going to say 1 XAU. Now, your account will also calculate for you, of course, for convenience, because people want to know what 1 XAU is. What did it go up in dollar terms or did it go down in dollar terms? So that will be reflected in the account, but they don't have to worry about whether or not the amount of XAU changed. And that's really important.
It's denominated in, let's say, quantity of ounce versus dollar value.
That is exactly correct.
Excellent. All right. Good clarification there. So David, I think a lot of our listeners really appreciate the importance of educating themselves on different issues like this. And you talk a lot about self-education. So share with us your thoughts about that, please.
I'm huge on that. I think that it's really important, whether you've gone through a formal education process or you're self-taught, those are personal choices. But what's really important is that you're choosing some form of education and building your knowledge set. And the most important starting point as it relates to financial decisions and potentially later career decisions it's really important to learn about money. Like, what is money? Why was gold used? Is it just a bunch of people, running around with tinfoil hats saying, gold's the best thing? It wasn't an accident. And that's really important. In fact, just a book recommendation, one of my favorite books on the subject is Gold, the Once and Future Money by Nathan Lewis. Amazing book, absolutely amazing book. Very easy read, just chock full of great stuff. So Nathan, if you're out there, that's a free plug for you. I don't know you, but I love your book. So, but that's a good book. And just understanding how the system works. Like, so many points of our life are touched by how we're able to interact. And the point of money is that it allows us to cooperate. And if we can't cooperate in society because the money's bad, then we have a very real problem. So understanding what is money and the best way that that's sound and stable for us, so we can do everything else we're interested in, is really, really, really important.
Yeah, I know I didn't learn anything about money or balancing an account in school, and that's why I appreciate getting to have conversations like this. So, David, tell us a bit more about where we can find more about you and CORO Global.
Sure, absolutely. So you guys can go to our website. It's CORO.global. Our product's available for U.S. Citizens right now in 21 states. We're adding more states right now, and our first international expansion will be Mexico and Canada, which we're working on for 2021. So for anybody in Mexico and Canada listening, we're coming your way next. And you can find our app if you're interested. It's available in both on iPhone and Android. And we invite all your customers to check us out, follow us, and learn a little bit more about us.
Excellent. David, thanks very much for your time today. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.